Today we're going to dive into how to master the market's natural rhythm. We're breaking down a classic swing trading approach that's all about reading the market cycles to find those really high probability setups. Hey everyone, welcome to AI Explains ICT. In this video, we're giving you a full overview of ICT's core content, specifically from month 6, episode 3. And trust me, you're going to want to grab a notebook for this one. We're covering some foundational concepts that are absolutely key. So here's what we've got on deck. We'll kick things off with what I like to call the market's compass, learning how to find our direction. Then we're going to talk about aligning all your time frames, which is a huge deal. After that, we'll get into the nitty-gritty, the life cycle of a bullish trade, and then flip it for the bearish side. And finally, stick around because we're going to cover something super important, what to do when a trade just doesn't work out. Okay, so first things first, before we even think about placing a trade, before we even look at an entry, we have to know which way the market is likely to move. Every single successful trade starts with having a clear directional bias. And for us, that all starts with our compass. This is the million-dollar question, right? It's what every single one of us is trying to figure out. How in the world do we know where the price is probably headed? Well, according to ICT, the answer isn't about guessing. It's about using a specific framework to map out the market. And that framework is called the PD array matrix. Now, I want you to think of this like a map of the market. It takes all the noise and organizes potential support and resistance levels into two very simple categories. Premium, think expensive, where you'd look to sell, and discount, think cheap, where you'd look to buy. It's that simple. This visual just lays it all out so perfectly. You've got the current market price sitting right there in the middle. Everything above that price, that's your premium territory, where you're going to find potential resistance. And everything below it, that's your discount zone, where you'll find potential support. It gives you a clean, organized view of the entire battlefield. So what's actually in this premium spectrum? Well, these are all the potential sell zones, the roadblocks where price could turn around. We're talking about obvious things like old highs, but also more subtle, powerful levels like a bearish order block or a fair value gap. Each one of these is a potential ceiling for the price. And then you just flip it over. On the discount side, these are your support levels. These are the zones where buyers are likely waiting to jump in. Things like a bullish order block, a fair value gap below the price, or even just an old low. These are your prime hunting grounds for finding a great buy. Okay, so having the map is step 1, but a map's no good if all the signs are pointing in different directions, right? Step 2 is all about getting the green light, and that means making sure our time frames are aligned. And this is absolutely crucial. The best, highest probability trades, they don't just happen on one chart in a vacuum. You're looking for confluence, where the monthly, the weekly, the daily, and the 4-hour charts are all telling the exact same story. When that happens, ICT calls it being in a buy program or a sell program. Let's make this super simple. A buy program is basically when the market, across all those big time frames, is respecting those discount levels we talked about and consistently pushing higher. And a sell program? You guessed it. It's the exact opposite. Price is hitting those premium resistance levels and heading lower. This alignment is what stacks the odds in your favor. And really, this quote from ICT just says it all. You can't argue with it. The path of least resistance, the setups that are just easier, they happen when you have this complete alignment. It's like having the wind at your back on every single time frame. All right, enough theory, let's get practical. We're going to walk through step by step what a classic bullish or long swing trade actually looks like from start to finish. So there's a 5-step recipe here, and it's pretty straightforward. First, you confirm your bullish bias on the higher time frames. Then, you wait for a big, strong rally, what ICT calls displacement. This shows you that buyers are serious. After that, you patiently wait for price to pull back, you look for your entry at a specific discount level, and then you ride the next expansion wave higher. This picture really tells the story, doesn't it? That first big move up, that's the impulse swing. It creates the trading range for you. Then, the market pulls back in a retracement, dipping down into that discount PD array matrix. That's your golden entry zone. You're not chasing the first move, you're waiting for the sale. And here's the really cool part, what makes this so powerful. Price is fractal. Think of it like those Russian nesting dolls.
The same impulse, retracement, expansion cycle that you see on the weekly chart is also happening inside each of those swings on the daily chart and again on the 4-hour. They're all nested inside each other.
Okay, so let's flip the coin. The best part about this whole model is its symmetry. It works just as perfectly on the way down, just in reverse. We're going to see how to ride that wave down. And you can see it right here in the bearish model. It all starts with that big, aggressive drop, the impulse swing down. Then price retraces up into that premium PD array matrix. That's where you're looking to sell short because you're anticipating that next expansion swing to take prices even lower. And just look at these steps. They are a perfect mirror image of the bullish setup. Confirm your bearish bias on the higher time frames, wait for that strong drop, patiently wait for the rally back into a premium array, enter your sell, and then target lower levels for profit. The symmetry is what makes the methodology so robust. Okay, let's talk about something that nobody loves to discuss, but we absolutely have to. Trading is not about being right all the time. It's about how you manage the times you're wrong. So let's cover the protocol for a failed setup. So yeah, what happens? You've done everything right, the setup looks perfect, you take the trade, and bam, it immediately goes the other way and hits your stop loss. Now what? Just winging it is not an option. You need a protocol. Now, this is where having a plan is a game changer. ICT lays out a very specific mechanical response. Step 1, do not panic. Accept the loss calmly. It's just a cost of doing business. Step 2, simply look for the next logical PD array. If your first buy failed, look for the next discount level down. Step 3, and this is so crucial for risk management, you enter that next trade with only 50% of your original size. And step 4, be patient. You're not trying to get your money back, you're just re-engaging with your plan. So let's boil all of this down. What are the big takeaways? First, you frame your market using the PD array matrix. See it as premium versus discount. Second, you wait for those major time frames to align. Third, you trade the natural rhythm: impulse, retracement, expansion. For longs, you buy that retracement into a discount array. For shorts, you sell the retracement into a premium array. And maybe most importantly, you have a clear, unemotional plan for when you're wrong. And that's the framework. You know, having a system is one thing, but having the discipline to actually follow it day in and day out is the real secret. If you got some value out of this video, please hit that like button and subscribe for more content just like this. And if you have any questions at all, drop them in the comments below and a real human will get back to you. Safe trading out there.